Yeah, the market position, I would say, probably should be a lot more cautious. And if you look at a number of the commentators this morning, they're saying exactly the same thing. But, you know, we've had this AI rally that's continued the rally that we've seen from October. It's largely interest rate dependent as people's expectations of interest rate rises slowing or maybe interest rates coming off. That's been happening. But, you know, the real narrative has been this interest rate narrative. What hasn't really come in is a potential recession narrative, or at least the slowdown narrative, slowdown in earnings, slowdown in economic growth. We're not really seeing that in the US, but we are seeing that in other places, seeing that in China. We're seeing that in other figures elsewhere, in manufacturing as opposed to services.
I'm glad you mentioned China, because that's where I want to round off this conversation as well. You are Hong Kong based, you get China more than many. And I found a very interesting comment that you wrote here. And it's just 3 words. You said China lacks confidence. And I've thought a lot about that. And I think China doesn't lack confidence. Xi Jinping doesn't lack confidence. But the Chinese consumer is lacking confidence as well. They've been hit for 6 on their property valuations. And that hasn't encouraged them to go out and spend money to stimulate the economy with the resumption of a more normalised economy. Just extrapolate for us and the audience what you see happening in China at the moment.
Well, confidence is an unusual thing. It's not just the property. It's not just the economic situation. It's the fact that people were really locked away for 2.5 years. And that makes it very difficult.
The world was.
China was exceptional. People were locked in their blocks. They had to rely on local resources for food, for medical, this kind of thing. It was something that had never really been seen in China's history. And I think this actually has put a great deal of emphasis on the fact that people really want to keep themselves to themselves. Now, the thing about confidence is that it takes time to recover. So actually, I've no doubt that as things develop, we'll see more Chinese tourists, we'll see more Chinese spending. But at the moment, I think the consumer in China is very tight. And that, of course, is now reflecting on the property market, which is showing some weakness, and other elements of the Chinese economy as well.
I was reading this piece on CNBC.com, Stephen, Richard, that talked about how a lot of big bank analysts, right, have revised their growth outlook, growth estimates for China downwards. JP Morgan has done it 6 times. I wonder what that means for investor confidence in a market which is so cheap and cheap for good reason.
Well, if you're looking at the news this morning with Cathy Wood of ARK saying she's out of China completely. So, you know, obviously like people are taking that view. I mean, I don't think I'd agree with that. I think where you look at China as a country investment manager, as I was for many years, you look at the market, the things of the market that really make that market. So France, you've got luxury goods. Germany, you know, the industrial sector is important. China, I think we're looking at tech, things like Tencent is still important, and the EV, the electric vehicle supply chain. You know, what's China going to be good at looking over the next 3 or 4 years? Those are the areas I think you want to invest in.